All right, today we're going to connect some dots. We're looking at high stakes diplomacy, brewing trade wars, and, believe it or not, a hidden economic threat that's being powered by artificial intelligence. Now, these might seem like totally separate stories, but you're about to see how they're all just deeply connected ripples in one very turbulent global pond. So, what is the connection here? How on earth does a potential political meeting in Alaska send shivers through the Swiss watch industry? And what in the world does any of that have to do with the servers that are powering the AI revolution? Sounds pretty random, right? Well, let's unpack this. So, our story kicks off with this first major ripple, a proposed summit between the US and Russia that's really forcing everyone to ask, who actually calls the shots when it comes to global security? And at the heart of it, you've got this huge clash. On one side, there's Putin's proposal, right there on the table. Russia gets to keep about 30% of Ukraine's territory, and in exchange, there's a permanent ceasefire. But on the other side, you have a pretty unified European front. We're talking France, Germany, the UK, Italy, and they're all saying absolutely not. Their stance is crystal clear. Nothing gets decided about Ukraine without Ukraine in the room. And as for Ukraine, well, they aren't mincing words. President Zelensky's statement here just cuts right to the chase. For them, any kind of backroom deal that trades away their sovereignty for ceasefire is a complete non-starter. It's dead on arrival. So you might be asking, if Europe and Ukraine are so dead set against this, why is it even a conversation? Well, it all comes down to leverage. The reality is, Europe is still heavily dependent on the US from a military standpoint. And we've seen this play out before, US arms shipments getting frozen, which can cause them serious problems. That power dynamic gives the US administration a massive amount of control, letting them basically decide who gets a seat at the table. And from their point of view, the goal seems pretty straightforward. Freeze the war, pull back on American commitment, and just move on. You know, this kind of hardball, my way or the highway approach, it isn't just for security summits. It's making even bigger waves in the world of global trade, which brings us to our second major ripple. The US-China relationship is in a very similar spot, basically locked in a standoff that's on pause with a 90-day truce. The US has a 30% tariff on Chinese imports. China is hitting back with 10%. Washington's key demand is more access for things like agricultural sales, while Beijing just wants relief from those tech tariffs. Right now, neither side is blinking, and that's creating this huge cloud of uncertainty over the global markets. So why hasn't China just caved under all this pressure? Well, they've got a pretty powerful ace up their sleeve. See, China has a near monopoly on what are called rare earth minerals. These are materials that are absolutely critical for, well, everything, from defense tech to green energy. It's the one thing the US really can't get anywhere else, and that gives Beijing a very powerful negotiating chip. And all these standoffs have kind of revealed this predictable and honestly dangerous pattern when it comes to negotiations. It's like a playbook. Step one is hope. Initial talks, some positive signs. Then comes step two, confrontation. A sudden aggressive accusation, often of being robbed. And it always ends with step three, retaliation, usually in the form of some pretty harsh punishments. And the recent breakdown of Switzerland is a perfect, almost textbook example of this. I mean, just look at how fast this all went down. On July 4th, the Swiss were feeling good. They thought they had a deal. Just a couple of weeks later, there's a really tense phone call where the US president is accusing Switzerland of stealing over a trade deficit. And by August 1st, the deal was completely off the table and massive tariffs were slapped on. The whole thing just unraveled in less than a month. And the retaliation was, wow, a 39% punitive tariff. That is the highest of its kind anywhere in the developed world. This isn't just some number on a screen. It's a body blow to the Swiss economy. We're talking about their famous watch industry and their massive pharmaceutical companies getting hit right where it hurts. So what's the big takeaway here? Why should the rest of us care? Because these incidents, whether it's with a giant like China or a smaller player like Switzerland, they pull back the curtain and show us just how fragile our whole interconnected global economy really is. It shows that any country, big or small, can get caught in the crossfire, and the price for that is incredibly high. Okay, so all of this tension, the diplomatic showdowns, the trade wars, it doesn't just stay in those arenas. It has to go somewhere, right? Well, it spills directly into the financial markets, and that creates our third ripple, a growing feeling that things are about to get turbulent. And to really get this, we have to talk about the VIX. The easiest way to think about it is as the market's fear gauge. When the VIX is low, investors are feeling calm, confident. But when it starts to climb, that's a big flashing sign of anxiety. It means people are expecting some big, wild swings in the market. It's basically a direct measurement of how nervous investors are feeling. And here's the kicker. History shows us there's a pretty clear seasonal pattern here. The VIX has a habit of spiking between August and October. So you take that historical trend and you add it to the already tense geopolitical climate we're in, and it really suggests we could be walking into a period of major market volatility. This quiet period we're in now, it might just be the calm before the storm. But hold on, there's one last, really unexpected ripple effect we need to cover. It's a risk that's been quietly building in the background, and it's being driven by the very technology that's supposed to be our future. This right here is the hidden cost of the AI boom. Right now, data centers, especially the ones training these massive AI models, are already using about 4.4% of all the electricity in the US. But just look at that projection. In just a few years, that number is expected to totally explode, maybe hitting as high as 12%. And to put that into perspective for you, that's more than 1.5 times the electricity that the entire city of New York consumes. It's a staggering amount of power. Now, you might look at this and think, okay, hold on. Electricity is only, what, about 2% of the official inflation number, the CPI? That's tiny. And you know what? You're right. The official weighting is small. But here's the catch. When the price of even a small piece of the puzzle starts to skyrocket, you feel that impact across the entire board. So here's how the chain reaction works. Electricity prices are already on the rise. They went up 5.8% just last year. Then you have AI's incredible thirst for energy, which is putting this huge strain on our power grids. That strain could easily push prices even higher for everybody, adding a whole new source of fuel to the inflation fire. It makes it really clear that the future of AI isn't just some tech challenge for Silicon Valley, it's a fundamental macroeconomic risk for all of us. And that really brings us full circle. From a potential summit in Alaska to a server humming away in a data center, all of these forces are connected. It shows that in the world we live in today, the ripples from one single event can travel incredibly far, often in ways we never see coming. And it leaves us with one last question to think about. In a world full of so many obvious risks, could the biggest threat of all be the one that's still hiding in plain sight?